Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to talk about one of my favorite topics, which is leveraging technical analysis for your options trading. Now, the reason I want to talk about this is because we all have our own views in the market, our views on specific stocks, ETFs, or more macro events. However, in order to trade options, we need to be able to time our trades. More importantly, we also need to make sure that we're deploying our capital as efficiently as possible for the outlook that we currently have in the markets. Whether you believe a stock is going to break out and make a very quick and fast move, or you think that a stock is near a support level and it's going to grind its way a little higher or a little lower against a support or resistance level, technical analysis gives us a very good outlook as to how we think a trade is going to play out. And it's very important to be able to utilize that information to select the correct option strategy on the back of that. So today what we're going to do is we're going to explore the different forms of technical analysis that you may utilize on your charts. And then more importantly, what is the correct way to deploy your capital for the different forms of technical analysis. Now, this is not meant to be a comprehensive view on technical analysis. I can't possibly cover all the different ways that you can read a chart, but I am going to cover the major general methodologies for charting and then show you why specific forms of options trades are useful for specific forms of technical analysis. And more importantly, hopefully show you why certain strategies are not useful for certain forms of technical analysis. Because in my opinion, I hope that you walk away from this webinar with a little bit more information as to when you don't want to use certain strategies, as well as which strategies you want to use. So the best way to actually learn it is through examples. So today, I'm going to go through as many examples as possible using real world symbols to show you what I mean. So before I get started, just a little bit of housekeeping. For those of you that are new to Options Play, welcome. For you to sign up for a free 30-day trial to the tools that I will be showing you here today, you can sign up using this link on your screen, which I will post into the chat window. And for those of you past your free 30-day trial, membership to utilize this platform is just $75 or $500 a year. Included in that is a free 12-step options trading course to help you jumpstart your options trading, as well as daily trade ideas that we send out to all of our customers every day. So please sign up if you don't already have access to it, and hopefully you support us after your free 30-day trial. Before I jumpstart into the topic here today, I just want to get a sense for the audience. Please bring up your chat window, which is at the bottom of your screen. And just a quick poll. How many of you currently utilize technical analysis in your trading? Either type yes if you use technical analysis or type no if you do not use technical analysis, just so I can get a sense for the audience here in the room. Okay, so I see a lot of yeses. I see a few no's and a couple of not much. Okay, great. So for those of you that are currently utilizing technical analysis, I think the methodologies that I'll be discussing here today are probably familiar to you. For those of you that are new to technical analysis, if you want to learn more about this, one of the great resources that I generally find for technical analysis is stockcharts.com. I will post that link into the chat window as well. Stockcharts.com provides a great resource for you to do free technical analysis. They also have a fantastic chart school, so that if you want to learn about some of the things that we're talking about here today to help you time your trades, more importantly, screen for trade ideas, technical analysis is extremely powerful to, at the beginning of day, instead of looking at 4,000 symbols, looking at maybe 10 to 15 symbols, and then looking at opportunities across a small segment of ideas as opposed to looking at thousands of ideas and trying to figure out which ones to trade. So here are the things that I want to discuss here today. First, I want to talk about what is the value of technical analysis. So for all of you that said that you don't use technical analysis, I want to show you why I use technical analysis in my trading. Then we'll talk a little bit about what are the option strategies for technical analysis, meaning if you use technical analysis, what type of option strategies should you consider learning or utilizing in your practice? Then we'll talk a little bit about the different forms of technical analysis. Price analysis, which I think is actually the most important form of technical analysis. And then we'll talk into more of the popular things like chart overlays, like moving averages, momentum indicators like RSI and MACD, and lastly, how to utilize these strategies in conjunction with each other. And each one of these, I'm going to go through some real examples to help solidify the types of trades that I'm going to show you here today. So, starting off the value of technical analysis, why do I use technical analysis in my trading? And the answer is technical analysis allows us to potentially forecast what's going to happen in the price of a stock based on its past history. And the idea is to try to anticipate what is likely going to happen in the future. So technical analysis, the best analogy that I can make is that history may not repeat itself, but it certainly rhymes, meaning we can find patterns that happen throughout history, and we see that they play out in very similar patterns. They don't play out exactly the same way, but many times they play out in similar patterns. And that's what we're trying to find are those patterns and see how we can apply those patterns to what is going to happen in the future. Now, the distinct difference between technical analysis versus other forms of analysis is that it provides three very important things that you need to have in order to trade options. And that's direction, first off, meaning when I'm looking at a stock, do I think that this stock is going to move higher, or do I think the stock is going to move lower? So direction is very important because that's the first and foremost thing that you need to figure out before you can place a trade. You need to know what direction do you think a stock is going to move in. The second thing you have to consider is the magnitude. Not only do I think it's going to move higher, but do I think it's going to move higher by $1, $2, $10, 10%, 50%? What magnitude? How far do I think a stock is going to go? That's the second thing that's important. And the third thing that's important is if I think it's bullish and I think it's going to move up $5, do I think it's going to make that move in a day, in a month, in a year? How long do I think that trade is going to make? Or I'm sorry, how long do I think it's going to take for that trade to work out? So by using charts, I can get a sense for all of these three things. And we're going to go through different forms of technical analysis to show you how we use the charts to gain a sense for direction, magnitude, and timing. Now, I just want to make sure everyone understands what I mean by direction, magnitude, and timing. If you understand, please type 1 into the chat window. I just want to make sure everyone understands those three concepts because they're really important for your options trading. Okay, great. I see a lot of ones. Perfect. So, let's talk a little bit about some of the pros and cons of technical analysis, right? So, number one, when you use technical analysis in the forms that I'll show you here today, what I like about it is that it provides me with a very objective view on price. Many people tend to find technical analysis as very subjective, but I tend to find that if you use technical analysis certain ways, it can provide a very objective view that doesn't require a lot of subjectivity. But the best part about technical analysis is the fact that it's applicable to all instruments with a price. Now, anyone who's ever traded stocks these days, you're probably familiar with the fact that you can't just look at stocks to do your analysis. You have to look at other things as well, whether it's looking at the broader market, whether it's looking at interest rates, whether it's looking at commodities, other influences that affect the stock markets. So one of the challenges is how do you then interpret interest rates if you are a stock trader? And the answer is technical analysis. Anything with the chart, you can utilize what you've learned to other asset classes. So the great thing about charting is that it's applicable to all instruments. So you can easily take what you've learned in technical analysis and apply it to looking at interest rates and other things that factor into your investment decision. And third of all, and my favorite part, is that we all have different time frames that we trade across. Some of you are very short term. You might trade intraday. Others are much more longer term. You might hold and invest hold onto a stock for months, possibly even years. And the great thing about technical analysis is that it's applicable to all time frames. So The methodology that you apply to a 5-minute chart is the same methodology you apply to a daily chart or a weekly chart. So it's really flexible regardless of how frequently or infrequently you trade, you can use the same methodology. Now, there are some limitations. So many times you learn about a technical analysis strategy that for certain inputs you buy, for certain inputs you sell. However, it's important to understand that when I say history rhymes, it doesn't repeat itself. That is absolutely true, is that you might find that certain patterns, you might be able to identify them really well, will only work out a certain percentage of the time. It's really important to understand that they don't work out all the time. So strategies only work in certain environments. And lastly, there's no such thing as what we call a best strategy, because I get a lot of questions from users saying, what's my secret sauce? What's my secret indicator that I use? And the answer is I don't have any. I use the same indicators that everyone else uses. I would say what my approach to technical analysis is actually a very simplistic view. And I've developed this after working with traders for years and years and years. I've been doing this as a market strategist for almost 13 years, where I've seen just about everything under the sun with respect to strategy. I've seen people use charts in so many different ways, I can't even count it. I have probably seen thousands and thousands of trading strategies, chart setups, people's charting packages, and I've seen the full gamut from very simple charts with almost no indicators on them to people who have 30 indicators on a single chart. So my strategy is to keep things really simple, because when you have 30 indicators on your chart, the only thing you're going to find on that chart is confusion more than anything else. So from my perspective, it doesn't matter which indicators you use. It's actually how consistently you use the same indicators day in and day out that dictate how reliable you can trade using those indicators. Because if you only have 2 indicators that you rely on every single day and you use them the same way, you will find much more consistent results in your trading than someone who has 30 indicators and is constantly flipping back and forth from one indicator to the next. That's when you're going to see very inconsistent results. So with that, what I want to talk about are 3 strategies that you can utilize for trading using technical analysis. Those 3 strategies are buying calls and puts, selling credit spreads, and buying debit spreads. Now, this particular webinar is not geared towards teaching you how to trade options. If you are unfamiliar with selling credit spreads, or if you're unfamiliar with buying debit spreads, that's okay. I have whole webinars just on that alone. So if you need to brush up on selling credit spreads or buying debit spreads, I highly recommend you to watch some of those recordings that we have on our YouTube channel to learn more and brush up on those strategies. Today, I'm going to focus more so on the charting aspect. And I'll talk about which strategies are useful. And then if you need to go back to learn more about those strategies, I highly recommend you to do that. Now, as you can see here on my chart, or rather on my screen, I have a division here between 2 sides of the coin. And on the left side, this is what I call trades that have a clear sense for direction. Remember what we talked about, 3 things that are important: direction, magnitude, and timing. So you're going to find, as I go through different examples, each one of them, we need to have a clear sense for direction, meaning, do I think the stock or ETF is going higher or lower? However, there are certain forms of technical analysis where I can get a sense for whether I think the stock is going to go higher or lower, but I don't have a clear sense for whether it's going to move 1%, 5%, 10%. There's nothing in that technical analysis itself that tells me how far that stock is going to move. And for those forms of technical analysis, this is what I call unclear magnitude, meaning I don't have a clear sense for a target price on my bullish or bearish view. On the flip side, there are other forms of technical analysis where I also have a clear sense for direction, but I also have a very clear sense for magnitude, meaning I have a pretty good sense for a target as far as how far I think a stock will move, okay? So before I move on into any specific strategies or any technical analysis, I just want to make sure everyone understands this concept that not every single trade or not every single chart setup that you're looking at will give you a clear sense for a target price. So if you understand that, please type 2 into the chat window. I just want to make sure everyone understands that concept. Perfect. So now that we understand that different forms of technical analysis provides us with different information, Now let's look at what type of strategies make sense when we have a clear sense for magnitude and which ones make sense when we don't have a clear sense for magnitude. Because that is the most important thing that will help you decide whether or not you are deploying your capital efficiently or not. So when we have a clear sense for direction and we don't have a clear sense for magnitude, it really depends on whether we think the stock is going to make a big move. If we think the stock is going to make a quick and fast move or more of a slow and neutral kind of grind, if you will. Okay, and I will show you which form of technical analysis each one of these categories fall under. But when we expect a quick and fast move, so if a stock is, for example, trading in a range and all of a sudden it breaks out above that range, right, then we might expect a quick and fast move. In that particular case, what we want to do is we want to buy calls and puts, right? We want to be able to take advantage of a quick and fast move, and buying calls or puts is a great way to go about doing that. Conversely, for that same example that I just showed you, perhaps the stock is just trading in a range and it's not breaking out. So every time it hits the bottom of that range, maybe you just feel that the stock is going to slowly grind its way up to the top, and whenever it hits the top of the range, you think it's going to slowly grind its way to the bottom. You're not expecting a big fast move. In that particular case, what you want to do is you want to sell credit spreads. So again, if this is a new strategy to you, come back and learn more about that. But for now, keep that in mind, that depending on whether you expect a fast move, maybe there's a catalyst coming up, maybe there's earnings coming up, and you think that, okay, this stock is breaking out, it's going to make a big move very fast, let's look at buying calls or puts. Versus if there's no real catalyst coming up and you think this stock is just going to grind its way higher or lower, you want to sell credit spreads. So I just want to make sure everyone understands that before I move on to the third part. So please type 3 if that makes sense to you. Perfect. So now there are other times where maybe you have a clear sense for direction. So an example of this, and I'll come back to this, is maybe you have a stock that's provided you kind of a bit of a head and shoulders pattern. And for those of you that are new to options trading, you might new to technical analysis, you might be saying, what is a head and shoulders? But a head and shoulders is really a pattern that gives you a very clear sense for direction, and it gives you a clear sense for magnitude. So if you have a clear sense for where the stock is going and how far it can go, I will show you why debit spreads, buying a debit spread, is the most efficient way to deploy your capital for the least amount of risk. So those are the 3 strategies I'm going to explore with you here today. And everything is going to be in the context of these 3 trades, because these 3 trades, if you can use just these 3 strategies alone, you will be able to trade, I would say, 90 to 95% of the opportunities that you find in the markets. So I'm actually going to come back to this because I have a couple of slides on just the best practices of each strategy, but I do cover that in depth in my webinars on those strategies alone. So I'm going to actually skip this. I'm going to jump over the technical analysis side because I want to jump through as many examples as possible. So first of all, let's talk about chart analysis. And what I mean by chart analysis is just reading the price, not using any indicators, not using any moving averages or anything like that, just reading the price, because price action is the only quote unquote leading indicator. It's the only thing that tells us as it is happening. Everything else, moving averages, momentum indicators, those are lagging indicators. They're only telling us what is happening in the past. So reading the chart is, in my opinion, the first and foremost and most important skill to learn as a technical analyst. So understanding what's currently going on the chart tells you how the stock is reacting. So when you read a chart, one of the first things you're going to learn is support or resistance. And support or resistance is an easy concept to understand. It's basically telling you where are there buyers and where are there sellers. So when a stock reaches a support level, that means that there is a bunch of buyers willing to buy at that particular price. And then if you have resistance level, that's where sellers are willing to sell at that particular price. So being able to see a pattern where you see a price level where there are consistent buyers coming in or consistent sellers coming in will provide you a very good sense for the direction of an underlying stock. However, there are 2 ways that once you've learned to identify support or resistance levels, there are really 2 ways that you can go about trading this. And it really sometimes depends on more of your views on the stock. Maybe you have a fundamental view on the stock. Maybe you have, you know, maybe there's a catalyst coming up that helps you determine which one of these two that you fall under. But the two ways that you can trade this is when it hits a resistance like you have here. One very popular way to trade it is believing that it is now bearish and it's time for the stock to now trade lower to the bottom of that range like we currently see on our chart. That is certainly one way to trade that. Now, if you believe that this stock has reached its resistance level and it's sold off and you believe it's going to continue moving lower to the next support level, this is where we have a clear sense for direction and we have a clear sense for magnitude. So if the stock's at $46, we believe the stock will go all the way down to $40. That's a clear sense for direction and magnitude. So for that, what you want to do is you want to buy a debit spread. In this particular case, you want to buy a put spread because a put spread allows you to buy a $46 put, which is the at-the-money put, and then sell a $40 put against that, providing you a very, very efficient way to take a bearish view for the least amount of possible risk on this particular trade. So if you understand that, please type 4 into the chat window. Great. Now, conversely, there's another way you can look at this resistance level. Now, perhaps you are fairly bullish on this particular stock. Maybe you really like this stock, but you are aware that there is this resistance level. So another way that you can trade this is, well, I'm bullish, or maybe I don't think this stock is going to move above 48 because 48 is clearly a resistance level, right? So you might not necessarily believe the stock is going to go all the way down to 40, but you believe that it's not going to go above 48. If that's the case, what you could do is you can take advantage of the fact that a stock is near its resistance level and be able to profit as long as the stock doesn't move above 48. How do you do that? You sell a credit spread. You can sell a $48 call, buy back a higher call, and effectively take profit or profit on this particular trade as long as the stock does not exceed 48. And because you have these three prior resistance levels, that gives you a pretty good indication that the stock is unlikely going to break that $48 level. And if that's the case, again, you can sell a credit spread. Even if the stock goes all the way down to 40 or stays at 46 or even moves higher to 48, you will still profit on that trade. So that's how you can utilize a support or resistance level to potentially profit from a trade. So I'm actually going to go through just an example real quick because, again, I think that's the best way to learn. And I'm going to use a stock that we've been talking about for feels like forever. I'm going to use Boeing. And I'm going to use Boeing because this is a stock that has been just stuck near a support level for a long time. 330 has been a pretty strong support on this particular stock. No matter what news comes out, this stock does not want to go below 330. So how can you use that information? Two ways. You can either believe that, okay, it's near its support level and I think will rally, and it has done that many, many times. Every single time it's hit that 330, 325 level, it's gone on and rallied anywhere from $60 to $50. So maybe you believe that history is going to repeat again. If that's the case, you might want to buy a debit spread, buying that current 329 or 330 call, selling maybe a 360, 370 call against it, allowing you to take a bullish view on this particular stock up to that 360, 370 level. That's certainly one way you want to play it. The other way is you might say, well, despite the fact that 330 is a support level, I'm pretty bearish on this particular stock just because of the news that's going on. So I believe 330 is a support level, but I don't think it's going to rally. Okay, that's fine as well. You can use a credit spread. You can sell a put credit spread and be able to profit as long as the stock stays below, stays above, let's say 330. You might sell a 330 put, buy back a 310 put against it, collect some capital, and as long as the stock just stays above 330, you will be able to profit on that trade. So those are the two ways that you can utilize a support level here on Boeing to be able to play it depending on your views on Boeing. So, I'm more on the bearish camp on this particular stock. So despite the fact it's near a support level, I don't believe it's going to have a strong rally considering the news that has that it's up against, or the headwinds that it's up against. So I would be probably more comfortable selling that put spread than I am buying that debit spread. But if you are in the camp to believe that, hey, this is a bottom, good news is going to come out soon, I think that it can rally back up to that 370, 380, then you might want to trade that debit spread. So does that make sense, everyone? Please type 5 if that makes sense to you. Perfect. Okay, so now let's look at the next way that we can use support or resistance. So support or resistance, as powerful it is, can also provide us with an alternative signal, right? So a stock can be near a resistance level and then break out. When we have these breakouts, that's when we tend to see big moves. So many times when a stock is near a support level or a resistance level and you get that breakout, sometimes that move can, come back to check that support level and really take off. Or sometimes it just takes off right from the get-go. Regardless, generally speaking, these types of trades result in fairly large moves. Now, when a stock breaks out to new 52-week highs, think about Tesla, right? When it broke out to new 52-week highs just a month ago, we didn't really have an idea as far as how far that stock can go. I certainly didn't think it can go all the way to 550. That is still crazy to me, but it happens, right? So when these quick and fast moves happen, we have a good sense for direction, but we really don't have a good sense for magnitude. So if you expect a stock to make a big move, long calls make sense, right? Because that allows you to really fully capture in that unlimited upside that you get on a breakout. Conversely, sometimes you might get a breakout on a stock that you aren't that bullish on, but because of the fact that it breaks out, you're fairly certain that it's not going to go back below that support level. So the other way that you can trade this is that maybe you think the stock is just going to now form a base above that resistance level. You can also sell a credit spread. So you can use this new support level as a support level, just like Boeing stock. So in the example that I showed you in Boeing, if a stock breaks out to a new resistance and is now support, you can sell a put credit spread. As long as the stock doesn't break that support level, you can make money. So those are the different ways that you can play breakouts. I do tend to find that it's more likely that you will find a stocks that will take on a big move than just a small move. But if you do think that the breakout is not that significant, and you think it's going to consolidate for a while, sell a credit spread. That's a great way to be able to take advantage of it. Now, the flip side, when a stock breaks below support level, so a breakdown, I will say breakdowns typically tend to have a better sense for magnitude, because in the sense of Tesla, when the stock made the new 52-week high, there's no old data that we can go back to look at it, right? So when the stock broke out above that 267, we had no historical data to go back to and say, well, how far do we think the stock can go? But when we look at Boeing, one of the things about Boeing, when we look at Boeing, we can actually go back in history and look back as to when the stock did move lower. So actually, Boeing hasn't gone below 320 in a long time. But if we go even further back, we can see that there are other price levels that we can reference back. So when you get a breakdown, you do have a good sense for where a stock can go in history. So that is something to also consider, that breakouts, you generally may not have a good sense for magnitude, but breakdowns, you generally do. So buying puts or even debit spreads sometimes are suitable. I just want to make sure everyone understands that before I move on. Please type 6 into the chat window if the difference between a breakout and a breakdown makes sense to you. Perfect. Okay. Let's move on to the next example. So the next one I want to talk about are our chart patterns. And this is the part that takes a little bit more practice. And chart schools, stockcharts.com's chart school has a great package on this to talk you through all the different types of patterns. I do find patterns to be much more subjective. Depending on who's looking at it, we might see different patterns. But I'm covering some of the major ones that are less subjective. So double tops and bottoms, clear sense for direction. So if you have a stock that's maybe formed a double bottom, which looks something like this, usually have a pretty clear sense for direction. It's a bullish move. However, double bottoms in itself does not give you a clear sense for magnitude. Keep that in mind. The only thing that a double bottom really tells me is what level do I believe the stock is not going to go below. So because of that, because I have a clear sense of direction, but I don't really know if the stock is going to rally, a little bit or a lot, selling credit spreads at a double top or a double bottom is usually the best strategy to utilize. Conversely, a different type of bottoming formation or reversal pattern called in head and shoulders is a little different, because the head and shoulders does give you a clear sense of direction and a clear sense for magnitude, because the head and shoulders has what we call a neckline. We can measure the size of that neckline, and the neckline provides a projection as to how far we think a stock is going to move. So on a head and shoulders pattern, you can use a long put or a long call if you're talking about an inverted head and shoulders, but you can also use a debit spread, because a debit spread allows you to more efficiently deploy your capital. And if you're not sure why that is the case, again, I highly recommend you to watch my webinar on debit spread, because it is one of the most efficient ways to take a directional view on an underlying stock or ETF. Cup and handle reversal, same thing, similar to head and shoulders, clear sense for direction, clear sense for magnitude. Cup and handle is more of a bullish reversal. So we usually talk about long calls and debit spreads, versus head and shoulders and more of a bearish pattern. And lastly, flags and pennants. These are also strong directional views, and they have a clear sense for magnitude. Very popular because they give you a projection, and you can use that projection to get a sense for where you think the stock is going to move. And you can use debit spreads in that particular case. So let's take a look at a few of these examples. First of all, let's look at Delta. This was the trade that I talked about last week. This is one of my favorite stocks, and this stock has been in a fairly tight range for a while. As you can see, $60 right here has been a pretty consistent resistance level on this particular stock. And on earnings earlier this week, it broke out above that level. So you could use that breakout as an anticipation that this stock is going to continue moving higher. So I hope everyone can see this. Delta recently, at that $60 level, broke out above, and my thesis is that this stock is going to continue moving higher. So that is an example of what you could utilize a call option for. If you didn't take the calendar that we talked about last week, and you think that the stock can continue moving higher on this breakout, now that we have the confirmation of the breakout as with earnings as the catalyst, buying a call option might be a great way to play a continuation of the stock moving higher. That's actually the position that I currently have on Delta. A pattern one I want to help show you is Starbucks, also a trade that we've talked about in the past. And the pattern that I saw on Starbucks is really an inverted head and shoulders. So what we have here is a left shoulder here on the right, a head over here, and then a right shoulder here. Now, as you can see here, the great thing about this particular trade is that we have a clear indication of how far the stock moved to the downside to enter the head and shoulders, which also gives us the same projection as to how far we think the stock can go to the upside. So I think that this stock, now that it's breaking out above this head and shoulders, can reach at that $96, $97 level, because we can use the previous history to help us project where we think the stock will go. So on this particular case, because I have a pretty good sense for direction and magnitude, buying a debit spread is really the best way to play this, because yes, I can buy a call option, but I'd have to spend $255 for a February call option. I can instead take the same bullish view and only risk $215, which would amplify my returns if I'm right on this particular trade, because I've reduced my cost and I've reduced my risk. So in this particular case, because I have a clear sense for direction, I'm going to, in theory, use a call spread here to take a bullish view on Starbucks. So I just want to make sure everyone understands that before I move on. Please type 7 into the chat window if that's clear for you. And Donald, I see a few questions here. Molly, I will send a link. It's just stockcharts.com. Let's see, there's a question here from Alex about Delta. What about short options expiring tomorrow? So I do recommend to simply close out that short options, the short call option on Delta, and hang on to the long call. That is the strategy that I would take. That's the strategy that I've deployed. And as far as the upcoming earnings on Starbucks, absolutely. That earnings catalyst is actually what we were looking to capture. And I think using a debit spread is a great way to capture that, because you're risking just about less than 3% of the underlying stock price to take a bullish view on Starbucks continuing that move. Many times I actually see earnings as the catalyst that it needs to get itself up to that $96, $97 level. And being able to trade that, risking only $215 for every 100 shares, is the way that I would play it. So let's move back. Again, I'm doing this back and forth thing now because I want to try to give you examples as we talk about these strategies, as opposed to going through the whole PowerPoint and then going through a few examples. Hopefully this makes it a little easier to see. So next one I want to move on to is moving averages, because this is one of the most popular indicators that people utilize in their trading. And moving averages, many times, as you might learn, is interpreted that when a stock moves below its moving average, that's bearish, like these two signals. When it moves above its moving average, it's bullish. And it's very easy to spot and fairly easy to scan for. However, one of the most, in my opinion, moving averages is one of the most, is one of the indicators that is used in the wrong way the most. And the reason I say this is because when you get a stock that moves below its moving average, what I tend to see a lot of users do is they buy puts. They think that this stock is bearish, or if a stock crosses above its moving average, they see that it's bullish. And in the examples that I show you on the chart, that seems to be the case, right? However, one of the things that a moving average does not tell you is magnitude. Meaning, if a stock crosses below its moving average, that crossover itself does not tell you whether that stock is going to move 2%, 5%, 10%. It could be any number of those. So because of that, you can't just assume that when it breaks below its moving average, it's going to make a big move to the downside, or it's going to make a big move to that upside. Yes, in this particular case, it does. But also the other thing you don't get a sense for is timing. A stock can cross above its moving average and stay there for a very long period of time. It can also cross below its moving average and come back within just a few weeks. So a crossover in itself does not give you any sense for magnitude or timing. And because of that, in my opinion, the best strategy to utilize on a crossover is actually a credit spread, because what a moving average is good at telling you is that when it crosses below that moving average, that sets a level or a new resistance level as to where the stock is unlikely going to move back across. And that's exactly what we see consistently. Every time it crosses below its moving average, you basically find either a new support or a new resistance level. And if you are able to sell a credit spread at those resistance levels, you have a very high probability of the stock remaining above or below that support or resistance level. So selling credit spreads, in my opinion, is one of the best ways to utilize a crossover. However, there are some situations where on a crossover, you do expect a quick and fast move. Perhaps there's an earnings coming up and you think that an earnings catalyst is something that's going to move the stock a lot. Then there is the case where on a quick and fast move, you can buy a long call or put. But again, I don't think that happens very often, at least certainly not on most moving average crossovers. But if you do have some kind of catalyst event, then you can buy a put option. So for example, maybe you have a stock that crossed below its moving average and you think the stock is going to make a big move very quickly. That's when it might make sense to buy a put. But more often than not, when a crossover happens, especially to the downside, what you've established is a new resistance level. When it crosses to the upside, what you've established is a new support level. And use credit spreads to take advantage of that. So that's my take on moving averages. So an example of this is, and I actually came up with an example from a crossover from just a few days ago. Let's take a look. O'Reilly Auto Parts. O'Reilly Auto Parts, as you can see here, crossed below its moving average here. Back here in late December, sorry. And that crossover, instead of being a bearish signal, what this really tells me is that there's a new resistance level on O'Reilly Auto Parts. And that resistance level is around this 439 level. So what I would do here, instead of buying a put option and expecting the stock to move significantly lower, is to sell a call spread. And as long as the stock doesn't cross back above that moving average, I can make money. And that's exactly what you typically see with these types of crossovers more often than not. Many times you'll get a crossover and it doesn't move in that direction that you expect it to very quickly. But what it does tell you is a new support or resistance level. So you can use a moving average to help you determine when a stock has formed a new support or resistance level. And selling that credit spread is a great way to trade that. So I see a lot of questions about what moving average I use. And the answer is it doesn't really matter that much as long as you use the same one day in and day out. So I've seen some questions about, do I use simple or exponential? Do I use 10, 20, 50, or 200? And the answer is, so to answer your question, I use simple moving averages, I use 20, and I use 50, and I use 200. Those are the three that I use. And they give me short, medium, and long-term trends. Now, I always use those three. And on top of that, our 1 month and 6 month trend indicator always use those three also. So our trend indicator is always going to use the same indicator day in and day out. It's always going to use the same interpretation of that moving average as well to give you a sense for bullish and bearish views. So it's more important that you stick to the same. So if you're going to use the 20, 50, and 200, stick to those three and don't change it from time to time. So keep that in mind when you're using your trading. And whether you use exponential or simple, it's up to you. My suggestion is whatever you choose, stick to it. Don't use exponential today and simple moving average the next day. But for those of you that like to trade moving averages, you can use Bollinger Bands as a directional move. And the great thing about Bollinger Bands is that they do give you not only a sense for direction, but also magnitude. Now, many times these trades are not large magnitude trades, but they do give you a clear sense for magnitude because a Bollinger Band is effectively a retracement trade. You're basically expecting the stock to reverse back to its mean. A Bollinger Band tells you when the stock is near an extreme and it's going to revert back to the mean. So Bollinger Bands are one of the few exceptions where you can use a moving average and have a clear sense for direction. So I just want to make sure everyone, I know not everyone uses Bollinger Bands, but for those of you that use Bollinger Bands, I hope that makes sense that is one of the strategies that allows you to use moving averages and have a sense for direction. Lastly, let's talk about leading indicators, or what is typically called as leading indicators, even though technically they are they are lagging indicators as well. Now, many of you use RSI, MACD, stochastics. These types of momentum indicators are very, very popular. And to be honest, a lot of people, in my opinion, misuse these indicators because, and unfortunately, this is some of the education that's out there that I think is geared more for stock traders than it is for options traders, is that we're taught that when you get a sell signal, that's a bearish strategy. When you get a buy signal, that's a bullish strategy. And many times I see users that when they get that buy or sell signal, they'll go out and they'll buy a call or a put in that particular direction. But if you look at the actual calculations of these indicators and you look at how they're actually used, what you'll find out very quickly is that these signals are telling you that momentum has reversed. Now, that's a very powerful tool in helping you get a sense for direction. What it's not good at is giving you a sense for magnitude, because just telling you momentum has reversed does not tell you how much it's going to reverse by. And that's not what these indicators are meant to do. It's not meant to tell you how far a stock is going to move. It's telling you what direction that stock is moving in. And those are two very, very different things. So when you get a sell signal on a momentum indicator, just like the moving averages, what this is telling me is that it's helping me establish a new resistance. When you get a buy signal, what it's establishing is a new support. And what you can do is you can utilize these tools to figure out where are some short-term support or resistance levels. And as you can see, it's a pretty reliable indicator at that. And every single time you have a new support or resistance level, what can you do? You can sell a credit spread, and a credit spread will pay or profit as long as that support or resistance level does not get broken. So really, really important thing to remember that momentum indicators many times are used as buy and sell signals, but they really, in my opinion, should not be used as buy and sell signals. They should be really giving you a sense for direction, but they do not give you a sense for magnitude. So sell credit spreads when you see these types of buy and sell signals, because they are very good, reliable indicators of when momentum has reversed. It just doesn't tell you whether momentum is going to reverse by a little bit or a lot. And I hope that that's clear to everyone. And for those of you that are not afraid of the math or not afraid of numbers, I recommend you to look into the calculations of some of these indicators, and it'll become clear to you that why that's the case, because it's really just telling you when something's reversing. It's not telling you how far it's going to reverse. So I just want to make sure everyone understands that. And I think the example that I want to use is, let's see, I think I have a stock here, Centene, the pharmaceutical stock. And I'm using this because Centene recently had a buy signal here, right? And again, what this buy signal does not tell me is necessarily that the stock is going to break out. Maybe there are other clues that tell me it's going to break out, like the fact that the stock broke out above its 52-week high. That's a whole different clue, though, that might change my opinion, right? But the momentum indicator itself crossing back above that negative 100 level is only telling me that Centene has a new support right here. And that as a trader, the only thing that I should really utilize this information with is by selling a credit spread. So selling a put credit spread that defends that level. As long as the stock doesn't go below $63, I can make money on this trade. I can incorporate other forms of information, like the fact that the stock has reached a new 52-week high. Maybe it has earnings coming up. So now I do believe the stock is going to move higher. Then it might make sense to buy a call option or buy a call spread. But that's other types of information that's helping me inform that decision, not the momentum indicator. So keep that in mind when you're using these momentum indicators, because I know a lot of you use them in your trading. Just make sure that you're using them correctly. And that is, in my opinion, why I do these webinars, to help illustrate why it's important to think about your technical analysis, not just follow what you might read on the internet, because a lot of the things on the internet, in my opinion, it was originally built for stock traders, because the stock trader is concerned about magnitude, but they're not as sensitive to timing as options traders are. So you might get a momentum indicator that tells you it's reversed, and you go short on or long a stock, but you can hold on to that for a long time. As an options trader, you need that trade to work out immediately. So that is the difference. So when you're using these momentum indicators, make sure you use it in that particular way. So with that, just to sum up what I discussed here today, in my opinion, if you're going to utilize technical analysis, the most important indicator is price. Learning how to read the price chart without any indicators first helps you give you, in my opinion, a much more clean and objective view on the individual stock. Once you have that objective view, you can utilize your indicators to help confirm or deny that view, but price is the most important one. Learn how to read price first before you learn about any other technical analysis. And as I said, indicators should only be used to help provide confirmation, not the signal itself. And the best way to do that is to keep things simple. Use fewer indicators to avoid what I call analysis paralysis. If you're the type of person who has 7 momentum indicators on your chart, chances are some of them are going to conflict, and you're going to have more trouble reading that chart than if you only had a single one that gives you more of an objective view. And the last thing I want to say is that you need to stay consistent with the same strategy. Meaning, if you're going to use RSI today, stick to RSI forever. Don't use RSI today, MACD tomorrow, stochastics the next day, because you're going to get very inconsistent results in your trading. Find an indicator that you understand, that you like, that you have a good grasp on, and stick to that. And understand your strategy fundamentally, because when you have a string of losses, and no matter what type of trader you are or how good of a trader you are, you're going to find yourself at some point in your trading career with a string of losses. And if you don't understand your strategy, chances are you're just going to jump ship and go to the next strategy. And the second you have a string of losses, then you're going to jump to the next. And you never find consistency in your trading. Try to stick to one strategy that you understand day in and day out, because you're going to find far more consistent results in the long run. As far as option strategy goes, make sure you think through what I just discussed with you today here. And think about, am I using the most optimal option strategy based on my direction and, more importantly, my magnitude outlook? Because again, many indicators give you the sense for direction, but not a sense for magnitude. And you want to make sure you're deploying your capital efficiently for that. Because if you're constantly buying calls on a stock that you're bullish on, but there's no real catalyst for that stock to move higher, guess what? You can get that direction correct, get that magnitude wrong, and lose money on that call option. We see that way too often, where in that particular example, maybe you should have just sold the put credit spread and you got that direction correct. And even if the stock doesn't move too much, you still make money on that particular trade. And I hope that this helps inspire you to utilize options play to really experiment with different strategies. So when you're looking at an opportunity in the market, you can ask yourself, well, in this Centene example, I have two choices. I can either buy a call option because the stock has made a new 52-week high and I think it's going to break out. I can buy a call spread, or maybe I'm more conservative. I'm just going to sell a put spread. I'm just going to sell a put spread because I'm not sure that Centene is really going to break out. I'm not too bullish on healthcare, but I do recognize that there's a new support level around $63. So let me sell a put spread and take advantage of the fact that I think the stock is going to stay above 63, and utilize our options play tool to see how the strategy performs. So even if the stock stays at $65 or even moves a little lower to $64, I can still make a profit by selling that put spread, versus if I bought a call or a call spread, I'm going to lose money, right? So, and many times I can even get the direction correct and still lose money. So that's really where I think the power of options play comes in, because it's one thing to have a really good sense for where you think the stock's going to go. It's a whole nother thing to know what is the best way to play that utilizing options. And that's what options play provides you with. So I hope that this inspired you to be able to take a look at our tool, take a look a little bit more in depth in technical analysis and thinking about your strategy and whether or not you're deploying your capital efficiently, and then utilizing options play to make that final decision as to what trade you want to make. So with that, I just want to thank everyone for taking the time out here this afternoon. I hope that this was useful in helping illuminate some of the benefits and usefulness of technical analysis, but more importantly, how to leverage the right option strategy on the back of those types of technical analysis. So with that, again, thank you so much for taking the time out here this afternoon. What I'm going to do is I'm going to open this up for Q&A. If you have any questions, please type them into the chat window. I tried to answer as many questions along the way as we went along, so I'll try to scroll up and see if I missed anything. I think I covered most of the questions here. So again, if you have any questions, please please let me know. Fred asked a really good question here. Does option pricing reflect magnitude? And the answer is yes. So when we talk about a call option, what is a call option? So when I say the February 28th $65 call, which is the at-the-money call, is priced at $3.20, what does $3.20 really represent? $3.20 represents what call buyers and call sellers have agreed on as far as where they think the stock can move. So that $3.20 is, determines the break even of that particular stock. In this particular case, this break even on this trade is $68.20. That's the market's expression as to how volatile do they think the stock will be. So yes, the option price reflects the market's opinion as to how much that stock can move. The less the market thinks the stock can move, the cheaper that call option will be. The more the market expects the stock to move, the more expensive that option is going to be. Great question. Casey is saying, besides support or resistance level, what other indicators are better to identify breakout or breakdown? The answer is I don't think there's anything better than support or resistance. Support or resistance is really the only indicator that you can use to identify breakouts or breakdowns. You can use trend lines. However, I do tend to find that trend lines tend to be a lot more subjective. So horizontal support or resistance levels are not subjective at all, in my opinion, and that's why I prefer utilizing them, and I think they're more reliable. Wayne is saying, why would we not do a vertical debit spread on a breakout and just take the first base hit? Well, Great question, Wayne. So let's say on Tesla's breakout, you traded a call spread, right? Then you probably would have made money on that first initial move and then lost out on everything else. It's really because if you believe the stock is really going to make a quick and fast move, and I have an example like Beyond Meat. I just thought the stock was going to make a big move, and I bought a call option instead of call spread. Yes, I would have risked less money, but in this particular case, I just thought the stock was going to make a big move, so I bought that call option. So it really just depends on how far you think a stock can move. Okay, I've answered all of those questions already. If I'm buying a monthly option, should I use a daily chart view? Yeah, I think so, Wayne. I think a daily chart is suitable for a monthly option. I answered all the questions around what moving averages I use. James is asking, what is the setting on Bollinger Bands? I'll be honest, I don't really use Bollinger Bands, but usually most people just go with the standard settings, which is 20-day moving average with 2 standard deviations on top of it. Jim is asking, do I use fibs or Fibonacci retracements? I rarely do because, again, Fibonacci's are, in my opinion, so subjective. It's so easy to change, where your, starting and ending points are, to adjust it to kind of get to the right levels that you want. So I'm generally not a big fan of fibs. I used to look at them a lot, and I certainly see a lot of people who use them. I think, you can use fibs as a support or resistance level. However, I think that fibs are more imaginary support or resistance levels rather than true support resistance levels, which is using price action. So I prefer to identify prices where a stock has actually reacted to. So here for Beyond Meat, I can see that on my chart, right around $84, the stock reacted to that multiple times. That tells me a real support or resistance level. If I just drew a fib line, they're kind of imaginary. So that's why I don't particularly like to use fibs. Larry's asking, do you consider unusual activity and call-put ratios as a part of trading strategy? I do not myself. I know many people who do, but I myself do not, because I don't really believe that just because someone else traded something, that necessarily means the stock is going to move in that particular direction. Sharma, Victoria, Peter, Jim, Wayne, Jean, Karen, Bruce, Gustavo, Angel, Sylvian, Casey, Lucy, thank you so much. Molly, thank you so much. Sue is asking, when I use a put spread, price going down, which leg I close out? Sue, when you trade a put spread, you should think of that as one single strategy. So you shouldn't think of them as separate legs. You should think of them as one bearish strategy that you want to enter as one strategy and you want to exit as one strategy. Alex is asking what to do with Delta now. I think if you're referring to the trade that I sent out on options action, my suggestion is to buy back the short call that you've sold and hold on to that long call. That's what I've done with that position. Howard's asking, how does IV enter into the choice of strategy? Howard, that's a great question. I generally tend to find that IV is more of a disqualifier than a reason to get into a trade, meaning if, let's say, I want to buy a call option on Tesla, and I realize that implied volatility on Tesla is at 99%, that just means that perhaps buying a call option is not the best trade to make. But just because it has high implied volatility does not necessarily mean that I should go out and sell, because my first and foremost is what is my directional view on Tesla? If I have a strong directional view and I have a strong sense for magnitude, it doesn't make sense for me to sell options, because selling options does not allow me to really take advantage of my directional view. So IV is certainly something you should consider, but it's more of a disqualifier than a reason to get into a trade. Jerry's asking, how to use volume relative to price action? So I don't use volume a lot, but volume can help you determine whether a support or resistance level that you're seeing is true or not. Meaning if you see a stock react to a certain price multiple times and you tend to see high volume around that time, that just goes to support that view that there truly is a support or resistance level there. If it's on low volume, it's less, I would say less of a significant support or resistance level. So that is how I would use volume for support or resistance. Michael's saying, if you change volatility, what will be affected? Just the option price. That's it. So option prices will increase in value as volatility increases. They will decrease in value as they decrease in volatility. So it really depends on whether you're long or short that option, whether you want volatility to go higher or lower. I guess I've already answered those questions regarding moving averages. What does the score mean on the platform? Would a lower score affect the direction? Great question, Gene. Gene's asking about the options play score. And the answer is that the options play score is not affected by direction. It does not have a directional bias. It assumes an equal probability of the stock moving up or down. And what it's really looking at is if the stock can move within a certain range, what is your best case scenario? What is your worst case scenario? And giving you a sense for how much money can you make versus lose, and giving you a sense for the risk to reward of that particular strategy, allowing you to compare multiple strategies side by side. So it's really a risk metric to tell you whether or not you have a good chance of making money versus losing money on a particular trade. The higher the score, the higher your probability of making money on that particular trade. Andy is asking, is Wealth 365 Summit is only online or the expert come together in a specific location? Great question. So I'm going to be speaking at a conference next Tuesday. I hope that you guys are able to come to this session. I will send a link to everyone to sign up for this. I'm going to be speaking next Tuesday at 10 a.m. Eastern. I'm going to be talking about how to leverage or how to utilize options for leverage but limited risk. So I just sent everyone a link into the chat window if you want to sign up for it. It's a great summit because there's about 80 different speakers. So not only do you get to hear me speak, you also get to hear about other speakers show you different strategies. It's a great way to learn more about trading in general. I highly recommend you to take a look at that. And you can sign up using the link that I just sent everyone in the chat window. But to answer your question, it is all digital. We are not in any physical location. Andy's saying, what indicator do you mostly use? Andy, like I said before, the indicator that I use the most is the price itself. I only use other indicators to confirm my views based on that price. I don't use indicators to generate my actual trading. Let's see. Oh, Jim is asking, do you accept PayPal for your service? Jim, if you don't mind, send me an email at info@optionsplay.com and I'll see what we can do. I think we can accept PayPal. But send me an email at info@optionsplay.com. Dominic is asking, what is POP? POP is probability of profit. So we look at the break-even price on a strategy and we look at what is the probability of the stock being on the right side of that break-even price to tell you what is the probability of you making money on a particular trade. Let's see. A lot of questions here today. Thank you so much for all of your questions. Arthur is saying, do you like point and figure? I actually quite enjoy point and figure. I don't use it very much. The reason I like point and figure is that it really removes the subjectivity out of everything. There's no time component to it. So you're really just looking at price action and price movement. And it's very good to help compare stocks one to another because it removes the time element of it and you really get a sense for relative strength. If you want to learn more about point and figure, there's a great resource called Dorsey Wright. We're actually integrated into that platform as well. I do recommend you to take a look at it. It is probably the most comprehensive point and figure service that's currently out there. KG is asking, who are the market makers? If everyone is buying a call, say 5,000 options for a strike on a certain date, who is selling it? The market maker is selling it. Now, that doesn't necessarily mean the market maker, I get this question because I tend to think that people are concerned that if you buy 5,000 options, that someone else has to be short 5,000 options and they want the markets to go against you. And the answer is that's not true because a market maker who sells you those 5,000 options immediately hedges their risk on the open markets with stock and they remove their exposure. So they are completely agnostic as to how that trade turns out after you buy your call option. Only you are. So don't be concerned that if you put on a large trade that someone has to be on the other side of this trade and is somehow betting that that is against you. That is simply not true. Dave is saying, will the seminar be available for replay? Absolutely. All of our webinars are available for for immediately distribution afterwards. Gustavo is asking, will you be in South Florida this year? I will be at the Money Show in Orlando in a few weeks. I think it's the first weekend in February. So for those of you that are making it out to the Money Show in February in Orlando, I hope to see you there. Excellent summary of trading fundamentals. People need to set up a plan and stick with it, learning more about what indicators actually work. Stanley, you're absolutely right. Fred is saying, what's your opinion on weekly versus monthly options? I don't discriminate, but I do find that weekly options, you have a lot more listing of strike prices. So if you need to fine tune your strategy and find exact strike prices, you're much more likely to find that on the weekly options than you will find them on the monthly options. So that is my take on weekly versus monthly. But from a trading perspective, they are no different from each other. Gene is asking, what does a score mean on your platform? I think I covered that. Claude is saying, where does the volatility number come from? If you're asking this volatility number, it's the implied volatility of that expiration date that we're looking at. So we calculate the implied volatility. Andy's saying, my question is in the Q&A. Yeah, I believe I've answered that, Andy. Alex is saying delta there would be a loss of 125%. Alex, I'm not sure what you mean. That trade should be up. We called the direction on that trade correctly. So you shouldn't see 125% loss on delta. KG is saying, how would you read the chart on Tesla based on your teaching today? Would you figure what strategy if time permits? Great question. So I actually sold the call spread on Tesla here because I just genuinely believe that we hit a new resistance level. I thought that 550 was a resistance level, and I sold the call spread that basically will profit as long as the stock doesn't go above 550. And the price movement over the last couple of days, I'm already up about 30% on that trade, so I would be close to taking profit considering I made 30% in just a couple of days, but that's how I would trade Tesla. I'm really hesitant to short any of these stocks. On Apple, I will say that I did buy one contract of an out of the money put option on Apple because just what the hell, I think that at some time in the next few months, the stock has got to reverse a little bit. So I did make a kind of, I would say, not a very normal type of trade that I would make. But, I threw that out there because I just thought that I want to hedge myself a little bit if the markets do come down. But more importantly, it's really difficult to short this type of market that's so strong. I think the better way to play it is that if you think something is overextended, sell that call credit spread to the upside and then basically believe that the stock is not going to go any higher. Is there a limit to the number of entries in my own options play watch list? Stanley, I don't believe so, but if you've hit 150 and you max that out, I believe you. I haven't put in a watch list with 150 names in there myself. Martin is saying, isn't pop just a reflection of delta? So delta is only telling you the probability of being in the money. That's different than the probability of profit because probability of profit is calculated off of your break-even price, not off of the strike price. So similar, but off of a different indicator. Bradley is saying link to this Dorsey service. It's Dorsey Wright, DORSEYWRGHT.com. So Dorsey Wright. I just sent you a link. I just sent you a name in the chat window. Wayne is saying, do you draw your own trend lines or rely more on exponential moving averages? I don't draw any trend lines. I do draw support or resistance lines. So horizontal support or resistance lines, I draw them myself. Teresa saying, where do you find the replay? Great question. So you can go to our YouTube channel, which I will post a link to the chat in the chat window for you to access our YouTube playlist. Have you ever used Andrew's pitchfork? I have not. I'm familiar with it. From my perspective, Andrew's pitchfork is kind of like a fib level, meaning it's more of an imaginary trend line or imaginary support or resistance level. I don't really see those, in my opinion, as a strong way to trade. But hey, it's, everyone's a little different. If you use, my suggestion to you is, if you're going to use Andrew's pitchfork, use it consistently. Don't use an Andrew's pitchfork today, use Fibonacci tomorrow, use the moving averages day after. Stick to one thing that you rely on, that you believe in, and utilize it. 1, 3, and 6 month on your platform, all based on daily or hourly? All of our signals are based off of daily candles, so we never use any hourly candles. Can we trade based on news and not looking at charts? You certainly can, but I think that you are missing out on information if you're just looking at the news and not looking at charts, because you can have a strong fundamental view on the stock. That still shouldn't prevent you from figuring out when is the best timing to get into that stock. And that's what technical analysis allows you to do. So even if you trade on news and fundamentals, look at the chart, because it gives you a much better sense for timing and knowing when to get in and when to get out of that bullish view. Alex is saying, ConocoPhillips 1 month and 6 month turned bullish. What does M means? Not sure what you mean by M. Where do you see M? Alex, if you can tell me, I'm happy to answer that question. What does the options play icon next to PLC and First Solar mean? It just means that it's a stock that triggered multiple scans. So First Solar, as you can see, triggered both the CCI overbought scan as well as the William %R bearish scan. So it just means that a stock, triggered multiple scans for that day. KG, you're very welcome. Jim, any concerns with low weekly volume and open interest on some? Certainly, if something has very low open interest, so if something has less than, let's say, 1,000 contracts of open interest, I certainly would be less likely to trade that myself. Philip saying, I lost link. Can you resend the link to the summit? Yep. Right here, 1 second. Philip, I just sent it to you. I just sent it in the chat window. Alex is saying, sold for $84.73, have to buy it for $1.90. If you're just referring to the short leg of the delta, yes, I understand you have a loss, but you also have a gain on the long leg that offsets that loss and some more. So you should be positive on the overall trade. How do you manage risk on those spreads? Gene, that is something I do cover very heavily on my webinars for those. So I recommend you to take a look at those webinars, because I do talk about when to take profit and when to cut losses. But it's a little too much for me to go over just in Q&A. KG's asking, Tony, if and when the market gets way overbought, well, I would argue that now the market is overbought, is it better to buy calls for March or April and UVXY or VXX? Great question, KG. I don't know, because I don't trade those products. I unfortunately just don't know enough to answer that question for you right now. If you want to send me an email at info@optionsplay.com, I'm happy to take a look at that. James is saying, do you ever use credit put spreads with a call option on a bullish situation? So James, yeah, so I don't use them very often, but you certainly can. What James is saying is that if you're bullish on a stock, sell the put credit spread, because you wouldn't mind buying that stock to the downside, but also buying a call option. So James, it's a very smart way to utilize options, to sell some premium and use that premium to buy an upside call option. Absolutely. Stanley saying, now that you're a famous TV star on CNBC, will you still answer my email? So Stanley, absolutely. Please send us your email at info@optionsplay.com. We will answer your questions as quickly as we can. Wayne, thoughts on William %R? William %R is a perfectly valid indicator. However, as I say over and over again, if you're going to use William %R, use that day in and day out. Don't use William %R today, stochastics tomorrow, MACD the day after. Use the same one, and use only one. Don't use all three, because they're all measuring the same thing. Stephen, we try to answer all questions within 24 hours. Adrian, how come all of the suggested trades are verticals, calls, or puts in the third box? Because that's the whole point, is we want to show you 3 different strategies, and we always want to show you the stock, a single leg, and then a multi-leg spread. Why don't more people use back ratio spreads for anticipated moves? Martin, that's a good question. I'm not sure. I think it's because ratio spreads are quite difficult to understand, and the fact that you are more short, which means that I think the reason that you don't use ratio spreads is because you can get your anticipated move, but then you still have to wait for the short legs to work its way out. So it's more of a slow burn strategy than a quick move strategy. And you're trading 3 legs, which makes it more complicated to trade and trade in and out of. You're trading, it's much less liquid. So buying a call option is far easier in my opinion. Alex is saying, should we keep Colgate-Palmolive into earnings? So Alex, I've been asking myself the same question here. The stock has managed to just be below the 200-day moving average here. I am concerned about it, and I do think that it might be time to cut your losses. However, let's take a look. So it did manage to break out above its 200-day moving average. So for me, that is concerning, and I think that it might be time to just cut losses on this particular trade, in my opinion. And Stanley brings up a good point, and that is, and I think I showed you this a little bit, but Stanley is saying that for those of you that want to trade more advanced strategies, you can always modify. Use our strategy constructor, and you can construct all types of strategies. So if you want to trade iron butterflies, condors, straddles, strangles, you can do that just by the click of a mouse and be able to move the wingspans out or flip a strategy. You can do all of these things with options play, move the strikes up 1, down 1, just by the click of a mouse. We call that options play for a reason, because we want you to play around with the different strategies and see how they perform side by side. So thank you, Stanley. I appreciate that. Sue is asking, what is a butterfly spread? Great question, Sue. I don't think I have enough time to get into it, but a butterfly spread is really just 2 credit spreads combined into a single strategy. Adrian, but there are many other option strategies, right? Anytime I check your site, it only suggests vertical calls or spreads. Am I doing it wrong? So you're not doing it wrong, and I just showed you how to look at some of the more advanced strategies. But Adrian, keep in mind, the 3 strategies that we show you up on your screen, that is what 80% of the volume in the markets are. So that's why we stick to those 3, because 80% of the trades that you make will be in those 3. In my personal opinion, those 3 strategies alone should account for 90 to 95% of the strategies that you trade. I think I've reached to the last of the questions here. Again, I just want to thank you so much for taking the time out here this afternoon. Today I spent 30 minutes answering your questions. I hope that I got to all of them. I really appreciate you guys taking the time out here every single Thursday to look at this and check out what we have to offer. I really hope that you guys find this useful. So I hope that you consider supporting us by becoming a member. You can do that by clicking on the link on your screen. By clicking right here on the link that I put into the chat window to sign up for a membership, which again is $75 or $500 a year, to be able to join us and continue your education, utilize our platform, and see the trade ideas that we put out every single week. So I look forward to seeing you guys next week. Next week we have earnings season coming up, so we're going to talk about how to utilize options to trade earnings. So I hope to see you guys there. So have a great evening, and I'll see you next week.